Sniper entries allow us to take trades like this and turn them into trades like this. But how exactly do you do it? How do you get these pinpoint entries on your positions to maximize profit potential? Well, there is one simple, single trick that you can use to start improving your entries, to get these sniper entries so you can brag to your friends and also maximize the amount of money you make on trades. So the first step to this is using supply and demand. You need to be entering from supply and demand zones if you want to get these sniper entries consistently. Supply and demand is also known as order blocks. You might know it as order blocks. It's basically an area of consolidation before a large up or down move that we look to enter from. So a demand zone is in an uptrend, a buying movement, and it is an area of consolidation before a large impulsive upward move. The candle that we would use as our demand zone in this instance would be this area here, this gray candle. Now, I like to use the last candle before the impulse. Some people suggest using the last down candle before the up move. In this instance, they would be exactly the same. The concept behind a demand zone is this was seen as an institutional area of buying, as we can see indicated by the large impulsive move that happened after that. These kind of large movements can only happen from institutional levels of buying. So when we see a consolidation like this, a sideways area before a large movement, we know that institutional traders and firms were buying at this point. Now, what does that tell us? Well, if they were happy to buy here before, we obviously know this price range between 2.05 and 2.035 is seen as a discount price to buy this asset from. So people were happy to buy pounds against the New Zealand dollar at this price point, which tells us if the market comes back to this point again, we can see the same kind of movement happening because people will be happy to buy once again once the asset is seen as undervalued or at a discount. Supply zones are completely the same, but the other way round. So if we were looking at a bearish market, we would see an area of consolidation before a large downward move with the concept that this is a premium price range. If the market gets up into here, traders will be happy to sell at a premium. Now, with the concept of supply and demand in mind, the sniper entries are taken by refining zones. That is what we're going to be covering in this video. And by the way, everything I show you now is going to be completely relevant between the high and the low timeframes. Doesn't matter if you're a swing trader or day trader, you can apply these theories. So looking at this example, we are looking at the daily time frame initially. We will go to some lower time frame examples in a bit, but we can see if we were to buy from this demand zone with an order on the zone and a stop loss beneath the zone, we would be able to get around 3.1% from this position. So if we entered here, our target was the next swing high, we'd make 3.1% if this trade won, providing we were risking 1%. So every $1,000 risked on this trade would be $3,140 back once the target is hit. That's okay. 3R is a good level to be trading with. If you can consistently get 3% returns at 1% risk, you're going to do just fine. But if there is opportunity to refine the trade and get a better entry, which means smaller stops, larger targets, bigger risk reward, then that is what we want to do. And that is where the sniper entries come in. So the key then is refining zones. What I mean by this is when we have this daily zone, we would want to drop to lower timeframes to identify any other zones within the larger zone. So this is the daily zone that we've just been talking about. Now that we've dropped to the 4-hour time frame, we can see there are some other demand zones sitting within. There is an imbalance here, and an imbalance, by the way, is an open price range. So we have demand, push away. This demand has not been retested, which creates an imbalance here. And there's also another demand zone area, consolidation before an impulsive move, and this one also has imbalance into it. So now we've got two zones that we could potentially work with. Because we have this significant imbalance, we would ideally want to focus on this lower zone, okay? We found the daily zone is accurate. We found now that all we are trying to do is lower the time frame to find a more refined point to buy from. And because there's still imbalance into this 4-hour zone inside of the daily zone, this would become the optimal point for us to buy from. So now, instead of entering up here with a 3.14% return for our risk, we could actually enter all the way down here at this 4-hour zone, and our stop loss could still go below the demand zone. Well, now we can see, if we jump back up to the daily time frame, by entering from this 4-hour zone, targeting the swing high, we've actually extended the profit potential of this trade from initially 3.14% at 1% risk to now 8.09% at 1% risk. Which means instead of making $3,000 for every $1,000 risked, we can make $8,000. So we've over doubled the potential of this position simply by refining the zone. If we had bought at that daily level, on that daily demand, we wouldn't have a sniper entry, okay? Our trade would be here. We're not buying into any wicks. We're not really catching the complete low of the movement. All we're doing here is just getting a solid entry for a conservative, simple trade. When we actually start to refine things, this is where we get those sniper entries where we're catching the wicks, okay? A sniper entry is generally where we look to enter on the wicks. We're looking for that final point of rejection and reversal before the trade moves in our favor. And refining the zones like this is exactly how you do it. It's rather simple, but it's very effective. So there's one example from the daily to the 4 hour. And now I want to talk about a point which is very important, and that is time frame relevance. So you can see here, we went from the daily to the 4 hour, then we stopped. Now what we could do is go from the daily to the 4 hour, and we could even go to the 1 hour time frame to see if there's any opportunity to further refine the zone. From the daily to the 1 hour is a reasonable time frame relevant set of time frames to work with. But we can see here on the hourly, there is no additional imbalance left open. There's no extra zones that we could refine to. So in this example, the best thing we could do is just stop here at the 4 hour. We've already more than doubled, almost tripled the reward potential of this trade. So there's no need to start digging lower and looking for extra opportunities. So for example, if we go too low, such as if we went all the way from the daily time frame for the larger zone down to the 5 minute, well, then we would see that there is an imbalanced 5 minute demand zone, which is this candle just before this large impulsive movement. And this could be seen as a sniper entry area. But the problem is we are not time frame relevant anymore. We have jumped time frames too far. If we're looking at daily zones, the 5 minute is so over refined that a lot of the time we're not going to get triggered into the trades that we are looking to take. So now with this 5 minute demand, we can see if we were to enter here with our buy limits and our stop losses below the low, yes, we would have a massive opportunity to get a really, really big trade. In this instance, we could turn that 3R and then that 8R into a potential 23.5R, but there is a massive risk of us missing the entire trade. And in my opinion, it's better to get even just 3% trade than it is to miss out on all of it. And I'm sure you would probably agree. So there is a problem here with over refining zones where yes, it looks nice when you're setting the trade up, but if you push things too much, you will miss the trades that you're looking to take, and you'll be very, very, very angry with yourself for not just accepting the 8% return when this trade is done and you haven't got any of it. So you can see just there on that 5 minute zone, we didn't trade into it. And that is simply because we're looking to buy from a daily zone. The daily, the 4 hour, the 1 hour, they're somewhat interconnected. They're very close to each other. So refining from daily to 1 hour is fine for your trades, but refining from daily to 5 minute is a very extreme jump, and there's a high risk the trades won't be triggered. Now, sometimes they will, and you'll get a huge, huge win. If that makes you happy, then you can go for it. But you have to be aware you're going to miss a lot of the great trades. And I think it makes more sense to not chase this crazy risk reward and just work with those time frame relevant timeframes. So now let's take a look at a slightly lower time frame example. Once this daily demand had been retested, or this 4 hour sniper entry had been taken, and the market pushed above some of the structure just here, that opens the doors to us taking confirmed entries following on from the initial retest. So if you're more of a conservative trader or you were late to the party, you might be looking for an entry within this range now that the market has started to push higher. So what we could do initially is use this 4 hour demand here to execute our trade, which would mean getting in at this high. So let's just place the entry there, putting our stop loss under the demand, and for this trade, let's target the same level. So we're looking here at a 12.4% return at 1% risk. Now, by no means is this bad. This is amazing. If you can take this trade, absolutely brilliant. However, there is opportunity to refine even further. We don't want to miss out on that if it's there. So if we jump down to the hourly time frame, we can now see that the market could be refined just a little bit further towards this hourly demand. So this would be, for me, the last consolidation move before the up move. Why am I interested in this as the last consolidation move? Well, this is the last candle before the significant impulse kicked up. So instead of buying on that 4 hour high, I'd now be interested in buying from the hourly high. We can have our stop loss under the low as we did. And if we extend the targets out to the exact same level, we've gone from a 12.4% potential return to a 15.48% potential return. So by simply using that hourly refinement, we've managed to get a bit more of a sniper on the entry. And now we've added around 3.1% to the profit potential of this trade. Okay. Now 3.1% is a really, really big profit. And if you continually can add that to your positions over time, that could add tens of thousands of dollars to your end of year profit just by following that simple refinement. Now for trades like this, we could go even lower. If we go to the 30-minute time frame, it doesn't really tell us anything new. Okay. So the hourly zone is this zone here. The 30-minute, well, the last candle before the impulse with this large wick would be this zone here. So it's exactly the same as the hourly area. Really, we wouldn't want to go too much further than, say, the 30-minute or the 15-minute at a very push on this position. If we went to the 15, we could refine things ever so slightly further, and we could catch a couple more pips, allowing us to get that real sniper style entry where we're getting into the trade here on the final wick, the final rejection before the upward move occurs. Now going from the 4-hour to the 15-minute is okay, but I would try not to push things that far, or don't push things further than that at the very extreme. You don't want to be going from the 4-hour to the 5-minute. Yes, you'll get those high risk reward once in a blue moon. Yes, you'll get those high risk reward trades of 20 plus once in a blue moon, but mixed in with that will be months of missed opportunities where you might as well have just gone for a smaller risk reward and still got optimized risk reward, but not quite as big, and actually been able to capitalize on them. So here, the 15-minute would have been good, but the hourly and the 30-minute were just fine. And they still added 3% profit potential to the overall position, which obviously is pretty brilliant. So that's actually all you need to do. It's very simple to get these sniper entries. You just need to be trading with supply and demand, or order blocks, as your core concept for entries. And then you can use those time frame refinements to go down lower and find zones inside of zones that will give you better executions. Here's a few trades that I've taken using this exact format. And if you feel like you want to learn more about the concept of supply and demand, just check out this video here. Also, there's a free course. There's a link in the description to that. I hope you've enjoyed the video. Thank you for watching, and I'll see you in the next one.